without the GDP growth that we really want.
So you got eventually something will go wrong, and you could certainly look back and point at the Fed. They have a very serious job. I think so far they've gotten us to where we are. We don't know what the exit looks like in full, but every single time, to point to them and say,
part of the point here,
policy
Josh,
mistakes,
though, is that I don't think the Fed clearly knows what the exit looks like in full.
Of course not.
Right?
Of course
They're
not.
sort of playing the game as it goes. Let's bring in Wharton Professor Jeremy Siegel for more on where he thinks the market goes from here. Professor, welcome back. Always good to talk to you.
Thanks. Thanks for having me.
So let's take a couple things. We had a guest on yesterday, as I mentioned already, who suggested, by history's suggestion, that we were going to go retest those lows. You think we do that, or is the market making a pretty clear statement today and subsequent days about where we are?
Well, first let me echo and agree with some of your guests that it was an overreaction yesterday in the market. This was, we have to remember, 3 weeks ago on January 31st, we hadn't had that stock market correction at all. We were 2 days from the all-time high. We also had, remember that crazy St. Louis GDP Now report, first quarter that's going to be 4 to 5%?
Yeah, Atlanta.
Smart Money says first quarter is going to be
Atlanta had us at like 25%.
just barely over 2%. And the fourth quarter is probably going to be revised down to 2.4%. So outside of a little bit of hotter news on CPI, all that super growth that they expressed concern about, 3 weeks ago has really cooled down in the recent data. Now, that being said, I do think we're getting 4 hikes. I think no one knows whether it's going to be 3 or 5. The Fed doesn't know. They look every single meeting at what the data is actually going to show. The important thing is, 150 to 200,000 jobs. We were marching along every month. We had really good, very low, jobless claims this morning that suggest another. We can't continue at that pace without the unemployment rate reaching down to 3.5% by the end of the summer, early fall.
Right.
And, we can all argue about where is that sensitive part, but 3.5% historically has sparked labor shortages and is a cause for the Fed to be more aggressive on tight.
So you got Bullard.
So unless we get a slowdown in that job growth, and I hope a speed up in productivity, which we thought we might have had, but some of the recent data is not suggesting that we really have. We have a situation of a tightening labor market without the GDP growth that we really want.
So you got Bullard today saying that if you have too many rate hikes, it could do damage to the economy. What gives you?
But don't forget, he's been a super dove.
Right.
I mean, his dot on the dot plot was below 1%. He thinks we're in a regime of 0 to 1% is the right rate. So he's been super uber dove of all the members of FOMC. So
I hear you.
And by the way, he was early on one of these people who said that this neutral rate of 4%, which the Fed thought several years ago was wrong, and it's got to be much lower. The Fed is coming down on what it thinks its long-term rate is. Now it's 2 3/4. But I think the big a month from yesterday, the March 21st meeting, that's really important. Powell going to be the first time he's going to be on the conference, and also we're going to get the new dot plot.